When we started this year, we had a broadly constructive outlook for markets, but we did expect to see continued bouts of volatility, not least given elevated valuations, increasing stock market concentration, and simmering geopolitical tensions. And that volatility certainly came to fruition. We saw markets shocked by investors questioning the potential disruption from AI and the path to monetization. And of course, we also saw the conflict in the Middle East and the war with Iran, which dramatically pushed up energy prices around the world. While markets sold off in response to those tensions, they also rebounded relatively quickly, which was encouraging and was in no small part fueled by the continued earnings growth driven by AI.
The underlying fundamentals are really strong, but the expectations have risen quite a bit as well. We are likely to see some additional air pockets in the second half of the year that portfolio construction is going to need to guard against.
One of the key questions we have now is whether markets are starting to become too complacent and underestimate the lingering effects of those market dynamics, whether that's continued elevated energy prices or the ongoing disruption from AI.
We think that the AI risk of disruption is likely to persist despite the fact that earnings growth has been growing at an incredibly rapid clip, moving from estimates of 15% this year to up to 25%.
And while oil prices have come down significantly from their peaks, we've had higher energy prices for quite a while now, which could ultimately start to impact the consumer. UK and European consumers were on somewhat weaker footing even before the war, and given the greater reliance on energy imports, could feel greater pressure from higher energy prices as we move through the second half of the year. The US consumer still looks to be pretty resilient in terms of spending patterns and has been somewhat more insulated from high oil prices. We continue to favour equities, and within that we particularly like the US. There we continue to see strong earnings growth, superior profitability, and capacity to really capture the secular growth being driven by AI. We also like emerging market equities, which is another way to gain exposure to some of that AI-fueled technological transformation. However, while growth is important, we also think you need to build resilience into your portfolios.
We think it's prudent to diversify with lower volatility equities, which can be highly defensive in times of market turmoil and come in at attractive prices today. We're also building a more inflation-resilient portfolio, both by considering assets like gold, as well as inflation-sensitive equities that are expected to deliver a real return in periods of higher inflation. So a flexible multi-asset approach that can shift between equities, fixed income, and commodity-related assets is incredibly important for providing the diversification and portfolio resilience that is required for this environment that we see today.